Okay, dear class, welcome to today's lesson where I'm going to be talking about the cash flows and how we calculate the cash flows to use in our DCF analyses. So first of all, where do we find these cash flows? Okay, because up until now, we've basically been, we're given the cash flows and then we simply plug them into our formulas. Now we actually have to calculate them. Okay, so how do you calculate them? Well, basically you dig them out of the financial statements that you're given for the companies that you obtain for the companies. So what do we do? What are the steps involved? Basically, there's 3 steps. So in the first step, what you do is try to determine what the existing current earnings of the company are. Okay, so again, which earnings you're looking at differs according to whether you're doing a firm valuation or equity valuation. If you're doing an equity valuation, then what you want are the cash flows to equity. Okay, so in this case, the cash flows to equity are the earnings after interest has been paid. Okay, so basically, if you remember the income statement, remember it starts with net sales minus cost of goods sold, gross profit, minus operating expenses, gives you operating profit or EBIT. So after EBIT, you have interest expenses. So you end up with EBT, and after taxes are paid, which will also need payment as long as the governments exist, you end up with net income. So in this case, what we're talking about, the earnings after interest expenses, the relevant one is the net income number. What is the current net income number from the last set of financial statements? If you're looking to value the entire firm, okay, so the value that belongs not just to the investors, not just to the equity holders, but also to the creditors of the company. In that case, the number you want to find is the operating earnings, EBIT. But again, we will adjust this for any taxes that need to be paid. So it's going to be EBIT multiplied by 1 minus the tax rate, 1 minus T. So that's the first step. What are the current earnings number? And then in the second step, we need to make adjustments to this number because not all of this is actually available to be paid out to the equity holders or equity plus creditors. Because a company that has to grow also has to continually make investments in its assets in order to allow the company to continue to grow. So we separate out this reinvestment into short-term and long-term assets that need to be invested in. So the long-term asset investments are called capital expenditures. And here, each of these also has a source of automatic financing for parts of these. So for example, for your investment in capital assets like buildings, equipment, machinery, and the like, you have depreciation expense, which is a non-cash expense, which we talked about earlier in the class. So we use net capex as how much needs to be invested above and beyond the resource, the financing automatically coming from depreciation. So first, for long-term asset investments, we deduct net capex from your number, and then second from your earnings number, and second for short-term asset investments, we can call these working capital investments. So you need things like cash on hand at the branches that you open up, at the stores that you open up. You need inventory, you need accounts receivable. So short-term assets. But part of this can be automatically financed with short-term liabilities like accounts payable, notes payable. So the difference of these is called our working capital. And also, we've said before, we sometimes refer to this as non-cash working capital. Why? Well, the cash portion, if it's excess cash being held by the company, you rather than try to determine how much of an effect this will have on the cash flows, you can simply deduct that from your assets, keep it separate because it's already in cash and it's already in present value. Keep it separate. At the end, we will add that to the total valuation. but the any new investments you need to make in non-cash working capital beyond that coming automatically from current liabilities. So for long-term, net capex investment, and for short-term, change in delta working capital is what we need to adjust for. And third, if this is an equity valuation, so if you're trying to obtain free cash flow to equity, in that case, you also need to think about, well, of these investments I need to make in long-term and short-term assets, did part of this investment come from new debt that was issued by the company? Okay, because that is another potential source for making these investments. If I'm the equity holder, that is money coming from somebody else, money that I don't have to put in. So we take into account these in calculating our free cash flows. So this is basically what it looks like. If you're doing a firm valuation, you start out with EBIT, multiply that with 1 minus the tax rate. So after tax cash flows available to investors and creditors of the company. From that, deduct the net capex, the investment you have to make in order to be able to grow in long-term assets, and deduct the investment you have to make in short-term assets, working capital. Okay, so change in non-cash working capital. This should give you the free cash flow to the firm. Okay, so this is where we are at. If you had been doing an equity valuation, if you'd been trying to calculate free cash flow to equity, well, some people argue, well, you should just look at dividends or dividends plus stock buybacks, because that is the actual payment that is made directly, the actual payment that is made to the equity holders. But we typically argue that companies may choose not to pay out all that they could for whatever reason. And in that case, if we simply use the dividends and the stock buybacks, we might be underestimating the actual value of the company, value of the equity of the company. So here, we're trying to calculate free cash flow to equity holders. So this time, rather than with EBIT, we start out with net income, which is the profit that belongs to the equity holders. From that, we deduct net capex again. We deduct the change in non-cash working capital, so long-term and short-term investments that are needed to allow the company to continue to grow. But here, this line is, notice, principal repaid, new debt issues. If you reverse that, that is actually how much new debt has been issued. By how much has the debt of the company gone up? So the company each period issues some new debt, borrows new money, and it pays back some of its old debt. So this is the difference of that. And again, if you reverse it, you could say plus any additional debt that was issued. So part of this investment coming from the creditors is adjusted for. And if your company has preferred shares, imtiaz licesenleri, in that case, you also need to take those out, because those again also need to be valued separately. They're not like common stock, they're preferred stock, and their valuation is different. They're actually also kind of in between credit debt holders and equity holders. So take out any preferred dividends as well when you're trying to calculate free cash flow to equity, common stockholders. So these are the 3 ways you can do that. Now let's take a closer look at this one. Again, free cash flow to the firm. And here, putting it into a formula, we can try to see what kind of calculation we need to make. So basically, yes, EBIT 1 minus T. From this, deduct the investment in fixed assets and investment in short-term assets, okay? And that gives you the FCFF. To simplify this a little bit, you might say, well, okay, I don't really need those 2 separate long-term and short-term investments, CapEx versus working capital investments, in which case you might say, okay, I'll just call all of that reinvestment. So EBIT 1 minus T deducts all of the reinvestments, and that gives you FCFF, is another way you could look at this. And it's even simpler if you find that the reinvestments that the company is making each period, if that seems to be a constant percentage out of EBIT 1 minus T. So if every year you're retaining in the company a certain percentage of the EBIT, in that case, the formula can be even simplified even more, so that you have your EBIT number, and from that you basically multiply it with 1 minus the reinvestment rate. So for example, if you're holding on to 30% of your EBIT to make these reinvestments, then 1 minus 30% is 70%. So 70% of your EBIT 1 minus T would be your free cash flow to the firm. So again, this can be used if the required reinvestment by the company is a constant percentage of the EBIT. And this will also simplify your calculations in your valuation. One thing that you might ask, well, in here, I don't see the tax savings, right? Because when I pay interest on the debt that I have, let's say I pay 100 liras of interest, keep in mind that if your tax rate is 20%, 25%, then only 1 minus T of that actually is an additional cost to the company. Because I pay 100 liras, but because my tax goes down by T times that payment, the actual cost to the equity holders is going to be less than that amount. So should this not be taken into account? Why isn't it included in this formula? Well, be careful, because actually in the valuation, it is included, but you don't see it here. Where do you see it? You see it in the discount rate that you use. Remember, in a valuation of the firm, you would be discounting this at the WACC, the weighted average cost of capital. And in the WACC, you have the cost of equity and you have the cost of debt. The cost of debt is an after-tax cost of debt. So the tax rate is taken into account there to lower the cost of debt. And it goes into the WACC, which then basically, ends up increasing the discounted cash flow results that you end up getting. So the tax shield in that case is taken into account, is included on the other side. If you also added it here, you would actually be double counting it, okay? So if you want to include it here, you need to use the before tax cost of debt in your weighted average cost of capital formula. So because we're using the after tax cost of debt, here we don't have to worry about adding back in the tax shield coming from the interest payments that the company is making. So is it that simple? Well, for many firms, yes, it is that simple, but sometimes we need to make some adjustments, or it's better to make some adjustments. In particular, 3 types of adjustments should be made to your valuation. Rather than just using last year's, end of 2021 financial statements, you might want to, 1, update the earnings, okay? So here, update the earnings, especially if your company is is a young company which is growing very rapidly, changing very rapidly. Just 3 months or 6 months might make a huge difference in its valuation because it has doubled its earnings or something like that. So it might be especially crucial for them. If the company is growing very slowly, it will not make much of a difference, okay? But yes, so one thing we should be doing is updating the earnings unless you're doing this valuation very early in the new year. Second, you might want to normalize the earnings or adjust for any cycles. These might be annual cycles or they might be, long-term cycles, business cycles. And the reason for this is depending on whether you are at the top of the economic cycle or at the bottom of the economic cycle, your numbers starting from that number may make a big change because we're going to use a constant growth rate from that number after a certain point. And whether you start from a high number or a low number or an average number can make a big difference in your valuations. So we're going to try to normalize that. If it's too high, kind of bring it down. If it's too low in the economic cycle, bring it up a little to help us try to estimate what we expect to see in the future. So that was 2. And finally, 3 is we need to clean up the numbers, cleanse the numbers for some problems in how accounting treats some of the numbers that we want to use. And in particular, here, we're going to go over some things like operating leases. Remember, leases are rental agreements. We had operating leases versus capital leases. Capital leases were long-term lease agreements that had characteristics of a purchase. So when you enter into a capital lease, you take the present value of all the payments and record that as leased assets in your assets and also as lease payment obligations in your debt. So it shows up. But if it's an operating lease, so there are rules, you will learn about this in your accounting classes, you've probably learned about them. If they're short-term, if the amount is relatively small, if there is no bargain purchase option at the end, stuff like this, then it can count as an operating lease. The advantage of this is that operating lease doesn't show up as debt in the financial statements. So sometimes this is called off-balance sheet financing, because you may still have significant obligations, lease payment obligations, but they are not recorded directly in the financial statements. So Damodaran correctly argues that if you have a lot of operating leases, it may be appropriate to convert these into debt and adjust the operating income for the payments made on these as well. The other adjustment that you might need to make is for research and development. Typically, research and development used to be expensed directly, but for a lot of companies which are spending a lot on research and development and using this to come up with new products to sell in the coming years, these R&D expenditures actually may be more like creating a long-term asset that they will benefit from in the long run. So for R&D expenses, which are directly expensed, it may be worthwhile converting these into an asset and adjusting the operating income for these adjustments. So we will see examples of how this can be done, and most of this chapter actually goes over those. I will be going over them pretty quickly. I'll try not to get buried in the details, and I'll try and give you the main important points of what needs to be done. Okay. And if there are any other problems, also clean those out. So, for example, expenses which are misclassified, financial versus operating versus somewhere else, we'll also try and adjust those. And finally, if you have one-time events which affected your company, so non-recurring expenses. So yes, they were real. They affected that one year. For example, if there was a big fire or if there was a big accident, earthquake, and so on, is that expected to happen again and again and again, affecting the future years? Typically not. So the effect of that may need to be cleaned out. For example, COVID is a big deal recently. So should we take into account COVID when we're trying to estimate the future? Some argue, well, it did happen. It's lasted, 2 going on to 3 years. But once it's cured, once it cleans out, it will not be affecting the future. So to estimate what the cash flows, what the net income and so on will be in the future, taking the effect of COVID out of the numbers and having a non-COVID earnings number that we use to estimate the futures may be appropriate for some companies. Or some might argue the war in Ukraine, right? the effect that that has on the Turkish economy, on Turkish companies. Is it going to be short-term or long-term? If it's just short-term, then in estimating the future cash flows, we might actually need to make an adjustment to help us estimate what we expect to see in the coming years. Okay, so those are the kind of three areas that you might want to update your numbers for. So let's take a closer look at these things. So the first one, updating the earnings, is, as you know, or should know, companies need to announce their financial performance at least once every 3 months. So they announce quarterly financial statements if they're on a stock exchange. In that case, rather than use their last annual statement, you may actually be better off, again, especially if this is a company which is growing or shrinking rapidly, then updated numbers, because that's what the market uses in its valuations, may be more appropriate. So rather than the last annual number, use a trailing 12 months. So this will sometimes be shown as TTM, trailing 12-month numbers for your earnings and other things. Or sometimes you may have access to information, informal, unofficial, or just an announcement by the company that our revenue is expected to drop or go up, okay? And that may have a big effect on the value of the company. So you, again, might want to take that into account. So yes, updating makes sense. And they also give you some examples of if you have a 10K, this is the annual financial statement, or a 10Q, these are US names that they use for these financial statements. So basically the 10K is the annual version and the 10Q is the quarterly financial statements. And you can obtain the trailing 12-month numbers by going in and using a combination of the 10K and 10Q. You can add up all of the 10Qs for the last 4 periods to get an earnings number, or you have some additional detail in the year-to-date numbers. Up to this point, this has happened. So some ways that you can utilize that. Other things you might want to do is make some corrections. For example, some expenses, items that you might see in the financial statements might be, according to the accounting regulations in one place as opposed to another place. Like what? Okay, so first of all, the definitions for a financial expense: any commitment that is tax deductible, yes, that you have to meet no matter what your operating results. Failure to make it leads to loss of control of the business. Okay, so if this is the definition of a financial expense, whereas an operating, then you have operating leases. These are simple rental agreements, not long-term, not very big amounts, and so on. So accounting includes these under operating expenses. But if you look at the definition, it looks like all of it, or at least part of it, should be actually under financial expenses. So accounting conventions treats operating leases as operating expenses, kira ödemeleri, rental payments, rent expense. They are really financial expenses and need to be reclassified as such, especially if the amounts are big. If the amounts are small, if you only have a very small percentage of rental revenue or rental expenses, it doesn't make a big difference. But in some industries, these can be very big, and whether they're included under operating expenses or financial expenses can make a difference for when you're using free cash flow to the firm, as opposed to if you're doing it for equity, it's going to be adjusted for in any place. So when you get down to net income, it will be in there anyways. So what else? What if you have some capital expenses also in your operating expenses? So again, what is a capital expense? Any expense that is expected to generate benefits over multiple periods. So things that bring you value long-term. A simple rental payment would not fit this, right? If you simply pay rent for 1 year on your store, on your factory, that benefits that 1 year. But if you buy a building, if you buy long-term equipment, right, that benefits numerous years. So those would be capital expenses. R&D typically is expensed in the year that the money is spent. Why? Well, this was kind of the result of having to be conservative, right? İhtiyatlılık prensibi. So if you're not sure how long these R&D expenditures are going to be useful for, and if they might not be useful at all, then you've already used it up. So to be conservative, we were expensing all of this directly. Recently, there have been some changes to this, but typically any money spent on research and development was expensed directly in that year. Now they've kind of separated out into research versus development. Ar-Ge versus Ür-Ge, araştırma geliştirme versus üretim geliştirme. And the research kind of side is still typically expensed, but the development, üretim geliştirme side, that one is capitalized because we know what we're going to be getting from it typically. But this argues if all of it actually creates benefit for the future. For example, Intel, right? Or Microsoft or Google, the money that they spend on research and development almost certainly is going to create valuable assets which will benefit them in the future in terms of new computer chips, in terms of new software and so on that they're developing. So in that case, you're creating a long-term asset, so they should not be expensed directly, and that's what they try to adjust for. So looking at how big operating leases are in different industries. If the overall average is just a little over 10%, these are for US companies. In apparel stores, so clothing and similar things, more than 40% of your operating income is operating leases. So out of your EBIT, about 45%, let's say, goes towards the rent payments on your stores. For furniture makers, about half of your EBIT is spent on the rent of your stores. Okay, restaurants about 25%. So these are quite high. And if they are mislabeled, if they're misgrouped, okay, so typically these count under operating expenses. But a lot of the furniture store, a lot of the apparel stores, a lot of the restaurants don't change locations very frequently. So even though the actual contract agreement might not be long-term, they are almost always long-term, kind of end up being long-term. So in that case, perhaps we might want to find a way to take this into account, because the payments that you're going to continue to be making are actually fixed payments that you have to make no matter what. And in that case, so it might not be for 20 years or however long it needs to be to count as a capital lease, but still an agreement for 5 years or 3 years still creates a considerable amount of fixed payments that you have to make. And in that case, that rather than being under operating expenses should be under financial expenses. So how do you deal with these? Okay, what do we need to do? Well, first, we need to calculate what the present value of the payments that you have to make would be, okay? So the present value of the operating lease commitments need to be calculated, and you obtain the present value at the pre-tax cost of debt. So this gives you the debt value of those operating leases. And that needs to be added in to your debt structure, because some companies whose debt ratio doesn't seem to be that high, sometimes because they have such high operating leases that their actual debt amount may be much, much higher than we originally had thought. So when you convert operating leases into debt, so when you increase one side of the accounting equation, obviously you need to create something on the other side of the accounting equation as well. So liabilities, yes, are going to go up, but so are assets going to go up. Well, you might say if it's increasing both sides, it doesn't affect the debt ratio, right? Not true. If your beginning debt ratio, let's say, was 50%, and then let's say so 50% of your total liabilities are coming from debt, the remaining from equity. Let's say you add in another 25 units of debt. So total assets become 125. So debt plus equity also becomes 125, but it becomes 75 over 50. So your debt ratio does go up when this is taken into account for. So it ends up affecting your debt ratio, your financial leverage, but it also affects your earnings number that you're using. So the adjusted operating earnings is your previous operating earnings. And in calculating operating earnings, or EBIT, we had deducted the operating lease payments. So we add back operating lease expenses to this, but we deduct the depreciation that you would have had on the leased asset, which is created. So when you include the value of the debt and you create a leased asset, that leased asset needs to be depreciated. And so you add in the lease payments back onto EBIT, but you need to deduct the depreciation that you would be experiencing on those leased assets. And yes, if you want to do it relatively quick and dirty, you can use this calculation as an approximation. So adjusted operating earnings plus pre-tax cost of debt multiplied by the present value of the operating leases can be used to approximate the amount. So here's a number example, a numerical example for the Gap company in the US, 2003. And the Gap had debt on its financial statements of about $2 billion, okay? Pre-tax cost of debt, 6%. Operating lease payments were about 1 billion per year. So 978 million in the most recent year. So here, you can find this information typically in the notes to the financial statements. The lease payments that they will have to make in the coming years based on their existing agreements. They will be making this much in year 1, in year 2, year 3, year 4, year 5. It goes down a little bit because some of the lease agreements are expiring, so they may not have to be renewed. So that's why it's kind of going down here. In year 6 and 7, we have this amount, 982 each year. And then present value of these commitments discounted at 6% per year gives us these amounts. And these also discounted gives us this. Adding all of them up, 4.4 billion approximately. So this is actually also part of your debt, which we don't see in the regular financial statements. So the actual debt outstanding of the Gap isn't 2 billion. It's more like 6.4 billion. Okay, so much more debt than we originally had thought. The operating income, the EBIT number, would need to be adjusted. So the stated operating income plus the operating lease expenses this year, minus the depreciation. So this year, we had operating income of about 1 billion, and we had lease payments, remember, coming from here, of 978 million. And then here, 4.4 billion divided by 7. Why divided by 7? Well, the leased asset has the typical lease agreement for the company is 7 years. So when they rent a new store, typically they sign a lease agreement for 7 years. It's not long enough to count as a purchase or a capital lease, but it's still 7 years, so it should be included. So this amount divided by 7 gives us, so 4.4 divided by 7, that gives us about 630, 628, something like that, this amount. And so, there's a positive difference here. And when you add that on top of the, 1 billion operating income, the adjusted operating income would be about 1.36 billion for this company. And if you use the shortcut formula of the present value multiplied by the 6% cost of debt, pre-tax cost of debt, 1.27 billion. So, that's the approximate formula that can be used if you're in a hurry. So again, why did we do this? One, the actual EBIT of the company is significantly higher if the expense and if the debt is properly accounted for. So using this adjustment, what effect does it have on the company? Well, let's take a look. This is another example allowing us to take this into account. Okay, EBIT and leases minus the operating leases, the EBIT that we had. Okay, and off balance sheet financing exists. However, right now it looks under conventional accounting as if they only have 1.9 billion in debt. Their cost of capital comes out to be 731. Cost of equity, 8.2. After tax cost of debt, 4%. Market value of equity comes out to be 7,350. So if you calculate a return on capital for this company, so EBIT 1 minus T divided by, so I have to take a look at this. This should be the value of the debt plus the value of the equity of the company. But I'll have to take a look at this. It comes out to 1290. But if the operating leases are treated as debts, how would this be different? Well, for one, the number that we use in calculating free cash flow to the firm, rather than starting with an EBIT of 1,012, you'd start out with an EBIT of 1,362. And in the balance sheet, okay, assets would be increased by this amount and your liability would be increased by this amount. But the debt, notice the big increase in the debt, because yes, assets is increasing, but all of that on the liabilities and equity side is being added to liabilities. So the debt ratio is going up. The cost of capital, which here was calculated as 731, here it becomes 625. So cost of capital, because you're using more cheaper debt compared to more expensive equity, the cost of capital seems to have gone down to 6.25. And the return on capital also is coming down. So it affects different sides of the equation, but all of this is going to have a pretty big effect on your valuation of the company. So we said we may also need to adjust for research and development. Well, the market average, again, for research and development as a percentage of EBIT is around 10% in the US. But in some industries, like petroleum, research and development, this might be developing more efficient ways to convert the petroleum you get out of the ground into the fuels, or it might be searching for new resources and so on. So they spend about 30%, but look at the computer industry. About 50% of EBIT gets spent on research and development, okay? So quite high numbers, and this probably will have significant effects on the numbers that we need to use. So here, what do we have? Well, R&D is typically expensed directly, so is part of operating expenses. But if it creates a long-term asset, it should be capitalized. It should be converted into, it's like buying a building, right? The amount that you spend to buy the building doesn't become all of it an expense of that period. So if we capitalize the R&D expenditures of the company, first of all, you need to estimate a few things. How long is that R&D created going to last for? Typically, I don't know, 2 to 10 years, maybe, depending on your industry. You need to go back and collect the R&D expenses for however long you've estimated this useful life to be. And you need to calculate the value of the asset which would be created as a result of this. So sum up the unamortized portion of the R&D, because even if you estimate a life of 10 years, okay, an R&D expenditures from last year, all of it would still be under assets. But an R&D expenditure from 5 years ago, half of it would have been depreciated already. So only 50% would be remaining. So you need to calculate the unamortized portion of the R&D and add them up to understand what your research and development asset would look like. And here, this is done for Cisco. They create communication and other hardware and software. So if it's assumed to have a 5-year life, so this was done in 1999 for the company, which at that year had an R&D expense of 1.5 billion. I think this number should be 1.5 billion. So all of that is going to still be in here, and it's already in present value, so it's not discounted or anything like that. For 98, the year before, this was the expenditure, and 80% of that would still exist, and some of it would be amortized each year. 97, 96, 95, 94, we don't go farther back than 94 because it would have been fully amortized by now. So even the 94 is fully amortized. The last amortization expense would have been incurred in the current 99 period. So adding these up, this is how much you would have from amortization of the R&D asset. And this is the expense which would be disappearing. Okay, or sorry, this is the R&D asset which would still be on the accounting records for this company. So assets are going to go up by about 3 billion for Cisco, and 484. This is how much expense is going to be in the income statement of the company. But keep in mind, this is going to be taken out. This is going to be added to expenses. So this is taken out from expenses. It's an operating expense. This is added as another expense. So the difference of about, what is that, 1.1 billion, there's going to be a 1.1 billion increase to EBIT as a result of this. So adjustment to operating income, this amount coming from here is no longer going to be an expense. This amount is going to be your new expense for 99, amortization of the R&D asset. So this 1.1 billion is going to be needed to be adjusted to the EBIT of the company. And again, conventional current accounting system versus if research and development was considered to be a capital expenditure and as a result capitalized. What effect would that be having on the balance sheet and income statement of the company? So please take a look at this as well. And, what else? Well, what if you had events which affected just that year or just that period? So, a strike or an earthquake or a fire or COVID not just affecting 1 year, but a few years. So you're valuing a firm that is reporting a loss of 500 million due to a one-time charge of 1 billion. what is the earnings you would use in your valuation? Would you use the loss, the actual loss of 500 million, or actually a profit of 500 million, which is what the company would have had if the event had not taken place? Well, if you really believe it was a one-time event and is not going to happen again, you should be using a profit of 500 million. Okay. So taking out the event of extraordinary events may be more appropriate. But if you think that, well, it's not really something that unusual. One example I had for a while, Asasan got into the habit of having reorganizations very frequently. An actual reorganization is something that should only happen either once every 5 or 10 years or even longer. But Asasan was having these almost every second year or every 3 years. So in that case, if you have an event which you think, yeah, it's one time, but it happens once every 3 years. In that case, maybe what you might want to do is take that 1 year expense, spread it out over 3 years to calculate your new number. Okay. But again, if it's truly a one-time event, then you probably would want to remove its effect when estimating the future years. So this is for SAP, again, a software company which develops software for enterprise resource planning, and R&D this time is, this is actually an example for capitalizing R&D, similar to the others. You might want to take another look at it. So again, it gives you, if it has a 5-year life, these are the expenses. This is how much of it would remain in the accounting records. So SAP actually has almost 3 billion worth of should have R&D assets in its books. And then what is the adjustment coming from amortization? 903 million. So as opposed to 1,020, 903 would be the new expense. So 117 million euros is how much EBIT would be higher if R&D was allowed to be capitalized. And then the calculations for it as well. Okay. What else may we have in our company which we need to adjust for? Well, accounting malfeasance. This is when the company kind of cheats with its numbers or lies with its numbers. And in that case, for example, if it's making its numbers higher or lower than they truly are, and you're able to spot this, you may want to make adjustments for these as well. So what do we do in that case? Yes, some companies are more aggressive. They take advantage of every little rule, while some are more conservative. A good investment analyst might be able to notice the difference and say that, oh, the actual difference of this company and this company is not a real difference, but it's due to using accounting assumptions in different ways. And so for a company that is pushing up its numbers, you may find a way to push down on those numbers to make them more realistic, versus another company which is being very conservative. Perhaps you might want to push their numbers up a little bit in your valuations. What kind of things might you want to look out for? Okay, so here they say some things which might raise question marks. Okay. Income from unspecified sources, holdings in other businesses that are not revealed, or from SPE, special purpose entities. This is something which Enron was using a lot of. In class, I gave the example of how can we create profit for 2 companies that are in trouble. Well, what if the 2 companies have some land, each of them have some land which are quite similar, and they sell this land to each other at a big profit? This would create extra profit in this year's financial statements for both of the companies, even if it was not a real profit, if they inflated the sales prices. But no money exchanged hands because both sides exchanged the land and created this profit for themselves. So if you see stuff like this, you might say, yes, the company is having a lot of problems, but magically from some strange source, this money is coming in. It kind of reminds me of in our in Turkey's numbers, sometimes we see a big number in money coming in from unspecified sources, net noksan ve hata. Wow, that typically should be quite small. You don't know where a small portion of the money flowing into Turkey is from, but if that number becomes a huge number, that may draw question marks. Or any company that is doing this, again, you'd probably want to be careful. Income from asset sales or financial transactions for a non-financial firm. So this might be a sign that they're having problems, but they're trying to hide this by selling some assets which they've had for a long time and whose values have gone up. And as a result, they seem to be selling them at a profit. So to kind of relax things a little bit, to make themselves look a little better, they might be creating these transactions. Sudden changes in standard expense items, for example, a big drop in SG&A or R&D as a percent of revenues. So some expenses, for example, let's take advertising expense. What would happen if Coca-Cola or Pepsi-Cola decided to cut it, excuse me, if Coca-Cola decided to cut its advertising this year by 50%? Wow, its expenses, advertising expenses, probably a huge portion of the total expenses of Coca-Cola. So if it decided to do that, wow, this year's numbers might actually look very good, especially if the advertising from the old years is still in effect. Or similarly, if Intel all of a sudden decided that it is cutting its R&D expenditure by 50%. Again, that R&D expenditure, cuts would push up its profit a lot for this year, but be careful because the revenue that's going to be generated by that is probably, 2, 3, 4 years in the future. So it would not harm this year's numbers, but it probably would be very bad for the company if it did that. What else? Frequent accounting restatements. If you find out that, every year they're having to adjust their announcements. They said this much, but it was actually this much. So it might be a sign that they're trying to play with the numbers. If there's a big difference, accrual earnings are always higher than the cash earnings. For example, they may be selling to people that they know they're not going to collect from. So the revenue from that and the profit from that would show up in the financial statements, but they're never able to collect. That would be a problem. And if there's big differences between the tax income and the reported income, again, that might be a sign of some problems. Okay. So I'll take a little break here, and then I will continue in a few moments. You guys probably won't even notice that. Okay, bye for